What's up everybody, it's Roz Ren, and welcome back to the channel. Today, we're diving deep into mastering your investments for 2026. Whether you're saving for a down payment, finally hitting that retirement goal, or simply growing your wealth, this video is your ultimate guide. We'll break down a strategic framework to help you achieve those financial goals. So, grab your notebooks, buckle up, and let's get started. Alright, before you even think about throwing money into the market, we need to talk about you. What are your financial goals? Are you grinding to finally buy your dream home? Is early retirement calling your name? Or maybe you just want to build a mountain of wealth? Defining your goals is crucial because it dictates your entire investment strategy. If you're aiming for that down payment in a couple of years, you don't want to be messing around with super risky investments. You need stability and steady growth. On the other hand, if you're playing the long game for retirement, you have more time to ride out market fluctuations and can afford to take on more risk for potentially higher returns. And hey, let's be real for a second, how much risk can you actually stomach? Are you the type who checks their portfolio every 5 seconds and freaks out over a 1% dip? Or can you sleep soundly at night knowing the market will have its ups and downs? Your risk tolerance is key to choosing the right investments. Do you prefer a conservative portfolio that prioritizes stability, or are you all about that aggressive growth, even if it means a wilder ride? Answering these questions honestly will set you up for success in the long run. Now let's talk about diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, the same goes for your investments. You never want to be overly reliant on any single asset class. Think of it like building a dream team. You want all stars from different positions, each bringing their A game. In the investing world, that means strategically allocating your assets across equities, bonds, and alternative investments. Equities, or stocks, are like the high-scoring forwards of your portfolio. They offer higher potential returns, but also come with more volatility. Bonds, on the other hand, are like your rock-solid defense. They provide stability and income, even when the market gets bumpy. And then there are alternative investments like real estate or commodities, which add another layer of diversification and can help hedge against inflation. But diversification goes beyond just asset classes. It's also about spreading your investments geographically. Don't just limit yourself to your home country. Explore opportunities in both developed and emerging markets. Remember, a well-diversified portfolio is like a well-balanced meal. It gives you the best chance of achieving your financial goals while minimizing your risk. Now, let's get specific. While diversification is key, you also want to capitalize on sectors poised for explosive growth in the coming years. So, where are the opportunities in 2026 and beyond? Clean energy is a no-brainer. With the world shifting towards sustainability, investing in solar, wind, and other renewable energy sources is like tapping into a gold mine. Then there's the EV revolution. Electric vehicles are the future of transportation, and the infrastructure needed to support them, like charging stations, presents a massive investment opportunity. Artificial intelligence and automation are transforming industries left and right. From self-driving cars to personalized medicine, the potential for growth in this sector is mind-blowing. And let's not forget about healthcare. As the global population ages, the demand for healthcare services and innovative medical technologies will only continue to skyrocket. Finally, keep an eye on advanced technologies like blockchain, cloud computing, and cybersecurity. These cutting-edge fields are disrupting traditional industries and creating unprecedented opportunities for investors. Chapter 4. Investment Vehicles. Now, how do you actually get your money into these high-growth sectors? That's where investment vehicles come in. Think of these as your different modes of transportation for reaching your financial destination. One of the most popular and efficient ways to invest is through exchange-traded funds, or ETFs and index funds. These funds track specific market indexes like the S&P 500, allowing you to invest in a basket of stocks with a single purchase. They're known for their low fees and broad market exposure, making them a cornerstone of many portfolios. If you're looking for a steady stream of passive income, dividend stocks are your best friend. These companies distribute a portion of their profits to shareholders regularly, providing you with a consistent cash flow. And if you're bullish on specific trends like clean energy or artificial intelligence, thematic funds offer targeted exposure to those sectors. These funds invest in companies at the forefront of innovation, allowing you to capitalize on specific growth themes. Chapter 5. Risk Management. Now, before you get too excited and start throwing all your money into the market, remember that investing always comes with risks. But don't worry, there are proven strategies to help you manage those risks and protect your hard-earned money. One of the most important is rebalancing your portfolio. Over time, some investments may outperform others, throwing your portfolio out of whack. By rebalancing quarterly or annually, you're essentially selling high and buying low, ensuring your portfolio stays aligned with your original risk tolerance. Dollar-cost averaging is another powerful tool, especially during times of market volatility. Instead of investing a lump sum all at once, you spread your investments over time, buying more shares when prices are low, and fewer shares when prices are high. This strategy helps smooth out the ups and downs and reduces your overall risk. And finally, no matter how much you invest, always maintain an emergency fund of 3 to 6 months of living expenses in a safe and accessible account. This financial safety net will protect you from unexpected events like job loss or medical emergencies, preventing you from having to sell your investments at a loss. Chapter 6. Tax Efficiency. Now, let's talk about taxes. Nobody likes paying more taxes than they have to, right? Well, the good news is that with some strategic planning, you can minimize your tax burden and keep more of your hard-earned money working for you. One of the best ways to do this is by maximizing your contributions to tax-advantaged accounts like Roth IRAs and 401 RKS. These accounts offer incredible tax benefits, allowing your investments to grow tax-free or tax-deferred depending on the account type. Another powerful strategy is tax loss harvesting. This involves selling losing investments to offset capital gains, reducing your overall tax liability. It's like turning lemons into lemonade in the investing world. Remember, tax efficiency is an ongoing process. Make sure to review your portfolio regularly with a qualified financial advisor to identify opportunities to minimize your tax burden and maximize your after-tax returns. Now, even with the best strategy in place, investors often fall prey to common pitfalls that can sabotage their returns. Let's talk about how to avoid these mistakes and stay on track for financial success. One of the biggest mistakes is letting emotions dictate your investment decisions. When the market takes a nosedive, it's tempting to panic sell and cut your losses. But remember, investing is a marathon, not a sprint. Stick to your plan, ride out the volatility, and avoid making rash decisions based on fear or greed. Another common trap is overconcentration. It's exciting to find a winning stock and want to go all in, but remember the importance of diversification. Spreading your risk across different asset classes, sectors, and geographies is crucial to protecting your portfolio from unexpected events. And finally, pay close attention to fees. Even seemingly small fees can eat away at your returns over time. Prioritize low expense ratio funds and be mindful of trading commissions, as they can add up quickly and erode your profits. Now let's put it all together with some sample portfolios tailored to different risk tolerances. Remember, these are just examples, and your actual portfolio allocation should be based on your individual financial goals, risk tolerance, and time horizon. For conservative investors seeking stability and preservation of capital, a portfolio heavily weighted towards bonds, with a smaller allocation to equities and alternative investments, might be appropriate. Moderate investors willing to accept some volatility in exchange for higher potential returns could opt for a more balanced approach, with a mix of equities, bonds, and alternative investments. And for aggressive investors seeking maximum growth potential, a portfolio heavily tilted towards equities, particularly in high-growth sectors, might be suitable. Remember, these are just starting points. It's crucial to work with a qualified financial advisor to create a personalized investment plan tailored to your specific needs and goals. The world of investing is constantly evolving, so staying informed and adapting your strategies is crucial for long-term success. Make it a habit to stay updated on macroeconomic trends, like interest rate changes, inflation, and geopolitical events. These factors can significantly impact market performance and influence your investment decisions. Keep an eye on regulatory changes and tax law updates. What worked yesterday might not work today, so staying informed about the latest rules and regulations is essential for making tax-efficient investment choices. And finally, don't be afraid to seek professional guidance. A qualified financial advisor can provide personalized advice, help you navigate market volatility, and ensure your investment strategy aligns with your financial goals. Thanks for watching. Remember, start early, stay disciplined, and avoid chasing short-term hype. Time is your greatest asset in investing, and the sooner you start, the more time your money has to grow. Remember, consistency is key. Develop a solid investment plan and stick to it, even when the market gets bumpy. By 2026, strategic diversification and the power of compounding can help you achieve those financial goals. Remember, investing is a journey, not a destination. Stay informed, adapt to changing market conditions, and never stop learning. And hey, if you found this video helpful, don't forget to smash that like button, subscribe to the channel, and hit the notification bell for more financial tips and strategies. Until next time, happy investing.